So mortgage interest rates, what impact do they really have on you as a prospective homebuyer when it comes to mortgage financing? We hear about rates all the time in the news. One day they're elevated, one day they're down, one week they're stable, they haven't really changed. Next week they're up again, or last week they were down again. But what does it really mean in terms of the affordability of a home for you based on how much money you may be borrowing? Because after all, at the end of the day, when you make a payment on a mortgage, whether that's writing a check or doing it online, there is a dollar sign involved with that, not a percentage symbol. So let's take a real quick look here at both variables and elements of what mortgage rate movement really means. I'm going to pull up another screen and we'll get to it. All right, so here we go. Mortgage interest rates. What exactly do they impact? Well, if we take a look here, mortgage interest rates ultimately influence or drive the monthly payment on an amount of money borrowed. Also influencing that is how long the money is going to be borrowed for. So they impact two things: affordability and qualifying. Now, affordability, generally speaking, is going to be a little bit more on the consumer side of things. What are you comfortable with in terms of a monthly payment for a given home or piece of property within the context of your household budget, your income, your debts, your lifestyle, your discretionary spending? The qualifying side, you could argue, is going to be a little bit more on the lender or mortgage banking side of things in regard to your income and your debts and what the industry would allow you to qualify for when analyzing all of those variables. So if we just quickly look at affordability, if we look at a $400,000 loan at 7%, you're going to see that the payment is $2,661 for principal and interest. So this is simply the repayment of the money borrowed. It does not include taxes or insurance. A $400,000 loan at 6% is coming in less expensive on a monthly basis at $2,398. And then that same $400,000 at 5% coming in yet less expensive than the prior two numbers at $2,147. Now, when you look at the swing here or the examples used as far as the interest rate numbers, you could argue that it is not a significant amount of movement on the monthly payment for a standard 30-year fixed rate loan here, but it could be enough of a swing that it takes a payment out of someone's comfort range at the elevated interest rate levels. Maybe it doesn't, but where it can come into play is on the qualifying side of things. So let's just say that a prospective home buyer has a maximum payment that they are comfortable with or qualify for at $2,398. So if we look at that amount monthly at 6%, it means they could borrow $400,000. Well, if we look at that same number at 7%, their buying power is decreased because now they could only borrow $360,000 and some change. But if we go the other way and drop that down to 5%, you can now see that they could borrow up to about $446,000, almost $450,000. And if we take it one step further to 4%, we can see that now you're up just over the $500,000 mark, all based on that same payment. So this is why oftentimes you will see a little bit of a slowdown in real estate activity at elevated interest rate levels and a pickup in activity at the lower interest rate numbers, both from the standpoint of qualifying and affordability. Now, there is a product or a feature, I should say, in the mortgage lending realm that is known as an interest rate buy down. So there are some strategies that can be employed to try to help overcome a given interest rate environment and allow someone to possibly purchase the real estate that they want or the home that they need and get their payment down into more of a qualifying or an affordability range. Now, when it comes to buy downs, there are permanent and there are temporary ones. I don't have time to get into those today, but if you have any questions, feel free to reach out at any point. I hope you found this information helpful. Make it a great day, and we'll look forward to seeing you again soon.